Whenever you start thinking about buying a property, your attention, it's laser focused on three things, right? The asking price, the location, and maybe whether the garden is big enough. But honestly, those details are just the glossy surface. The real complexity, the true measure of risk, lies in all the non-financial regulatory and environmental factors you just can't see.
That's so true.
So today we're going way beyond the viewing, and our mission is to make sure you never get caught out by these hidden hurdles.
Okay.
Let's unpack this.
That's right. Because when a mortgage lender looks at a house, they aren't looking at its charm. Not at all.
Wrong.
They are doing pure risk mitigation. They have to be completely satisfied that the property serves as sufficient security for the, massive loan they're giving you.
And if it doesn't?
Well, if a property has a non-compliant extension or if it sits on ground that is actively subsiding, that asset's value is instantly compromised. And if the asset is compromised, so is their ability to get their money back.
Our sources today, basically a guide for UK property lending, are the due diligence checklist every solicitor should be using. We're giving you the shortcut to understanding all these necessary checks.
Everything from planning consent versus building regulations.
To environmental liabilities like radon gas, and then into the shockingly complex financial final lap with things like stamp duty surcharges. We have a lot of ground to cover.
We do, and we should probably start at the foundation because we have to separate two requirements that buyers always confuse: planning consent and building regulations.
Okay.
Planning consent is all about the external impact. It governs external changes, the proposed use of the property, like converting a home into flats, and how it affects the local area and your neighbors.
So if I want to put up a huge two-story extension, I absolutely need planning consent because that affects my neighbor's light and the whole look of the street.
Precisely.
And here's where the liability comes in, right?
Yeah.
Failure to get this consent is, well, it's potentially catastrophic.
It really is. If you buy a property where the previous owner failed to get the right planning, the local authority might just refuse to accept the work retrospectively.
And then what?
They can issue a compulsory order forcing you, the new owner, to tear down the extension, to reinstate the property to its original state.
Wow.
That results in heavy, often ruinous expenditure. It's why lenders absolutely demand evidence of compliance before they even think about lending.
And building regulations, are they just another layer of bureaucracy on top of that?
They're entirely separate, but just as critical. Building regulations relate to the internal structure and the materials used. They ensure health and safety things like fire escapes, insulation standards, proper foundations. So something might not need planning consent, but it still has to satisfy really strict building regulations.
This leads us to a crucial concept that anyone renovating needs to get their head around: permitted development, or PD. This is the work that the government lets you do without needing full planning consent. It speeds things up a lot.
It does, but, and this is the key takeaway, PD rights are incredibly complex and come with very strict limitations.
Like what?
If you're building an addition, for instance, all your structures must not cover more than half the land area around the original house. And the definition of original house is vital here.
What does that mean?
It means the house as it stood on July 1st, 1948, if it was built before then.
Wait, 1948. So if house was built in, say, 1960, the original house is the 1960 footprint. But if it was built in 1930, we're talking about how it looked in 1948.
That's exactly right. The 1948 cutoff is the legal baseline, and it gets more specific. If you build a two-story extension, it can't be closer than 7 meters to the rear boundary, and the depth can be no more than 3 meters from the rear wall of that original house.
That level of detail shows why lenders get so nervous. Break any of those rules, and you're back in danger of that expensive reinstatement order.
And we should stress, PD rights are severely restricted in what's called designated land.
Like conservation areas or national parks.
Exactly. If you're buying in one of those areas, you should probably assume you need permission for everything.
Okay, so we've nailed the regulatory checks for standard builds. But speaking of heavy restrictions, what about properties with special status? That must put immediate limits on things. I'm thinking of listed buildings.
Yes. These are buildings with architectural or historical significance. And the key takeaway is that you need consent for any change to the fabric of the building.
And that includes the inside, right?
Yes, even the interior. You might think moving a doorway or removing an internal wall is fine, but if it affects the special character of that listing, you need consent.
And getting consent is just the first hurdle. The cost must be huge. You often have to use period-specific materials, which are way more expensive than modern ones.
For a bit of context, in England and Wales, about 92% of listed buildings are Grade 2, which is special interest. Grade 2 buildings, particular importance, make up around 5.5%.
And the really exclusive one.
That's the 2.5% that are Grade 1. Buildings of exceptional national interest.
That's a great detail. And the restrictions aren't just for the building itself. You have conservation areas, which restrict whole neighborhoods.
You might even need a tree preservation order just to prune a tree on your own land.
Okay, let's go deeper. We've covered visible liabilities. What about the silent dangers? The truly invisible environmental factors that can just kill a deal.
Top of that list has to be radon gas.
Radon gas. It sounds terrifying, but what exactly is it?
It's a naturally occurring radioactive carcinogenic gas. It's odorless, invisible, and it's present in high concentrations in certain parts of the UK.
And how does it get into a house?
It just rises up through cracks in the floor and can accumulate inside. Lenders will always require a check, especially in affected areas, because high levels need remediation.
Which sounds expensive. What does that involve?
It's typically fans and pipes underneath the property to suck the gas out and blow it away from the foundations. For new builds, they install a special radon barrier. Without it, the property is a health hazard and, well, its value is reduced.
Then you have contaminated land properties built on old industrial sites.
Like old gasworks or landfills, yes, that's another critical search in the due diligence process.
And then there's geology and subsidence.
Exactly. Areas on London clay are particularly prone to movement. The good news is, for old mining areas, the Coal Mining Subsidence Act provides a framework for repairs. But the bad news is, if a property shows evidence of present or active subsidence,
That's a problem.
it's a huge problem. A specialist report is always needed, and most lenders will just deem that property unsuitable security for a mortgage until it's completely fixed.
So past problems might be okay, but current problems are a hard stop.
A very hard stop.
Okay, let's shift gears to a newer liability, one that often surprises buyers: renewable energy. Specifically, these rent-a-roof schemes.
Right. It's fascinating because government initiatives are designed to help homeowners profit from exporting energy.
But some companies turn this into a real trap for future buyers.
They did. In these schemes, a company installs solar panels for free. In return, they take out a legal lease on your roof space for a very long time, often 20 to 25 years.
They get the benefit from the energy, you get a free installation. It sounds great, doesn't it?
It sounds fantastic until you try to sell your house.
And that liability is just passed on to the new buyer.
Yes. The new owner is legally obliged to continue that arrangement until the lease term ends. They inherit the panels and the contract, whether they want them or not.
Wait, so I buy a house, and some company owns the lease on my roof for 2 decades. That must restrict what I can do with my own property.
It does. You need the company's permission for any alteration that affects the roof, like a loft conversion. They can constrain it or even block it entirely.
And the maintenance.
And here's the kicker. Maintenance and repairs are usually the responsibility of the owner, not the company that's profiting from the energy.
Wow, that is a genuine trap. You're stuck with the contract, you have restricted renovation rights, and you have to pay to maintain a system that isn't really yours.
It's no wonder some mortgage lenders are so reluctant to offer mortgages on these properties. It just shrinks the pool of potential buyers.
Okay, let's move into the purely financial traps now, starting with the lender's own risk assessment. We're talking about the loan-to-value, or LTV, ratio.
The mortgage as a proportion of the property's value. Most lenders have a maximum threshold, maybe 75% or 80%.
And if you need to borrow more than that.
If you require a higher LTV, say 85%, the lender may charge what's called a higher lending charge, or HLC. It's usually a single, pretty substantial payment added to the loan.
This raises a really important question. If I'm paying this HLC because my mortgage is riskier, is this charge basically insurance that protects me if things go wrong?
Absolutely not. And this is one of the biggest paradoxes in lending.
Okay, run me through it.
Imagine a property valued at £168,000. You need to borrow £144,000, which is an LTV of about 85.7%. The lender's comfortable threshold is 80%, so the extra risk is that £9,600 difference.
Right.
So they might charge a 4.5% premium on that extra risk, which is about $432 added to your loan. That charge pays for a mortgage indemnity guarantee policy, or MIG.
A MIG policy.
And that MIG policy is an insurance contract that protects the lender if you default. You pay the premium, but you get zero benefit from the payout.
Wait a minute. I pay for a policy, but the policy only protects the lender from my failure to pay. That feels it feels inherently unfair.
It gets worse. If the insurer has to pay out a claim to the lender, say £10,000, they can then use a legal right called subrogation.
Subrogation.
It means they step into the shoes of the lender and get the right to seek recovery from you, the defaulting borrower, for the amount they paid out.
Let me get this straight. I paid a fee for an insurance policy designed entirely to protect the lender, and then that same insurance company can turn around and sue me to get back the money they paid out.
That's it in a nutshell.
That's truly shocking. You're paying for a policy that's designed to hunt you down later.
It's the definition of a financial trap. In England, they have about 6 years to come after you.
Which brings us to the financial final lap. All the non-refundable fees and property taxes. Before you even exchange contracts, you're spending significant money on what are called disbursements.
Right. The key non-refundable searches your solicitor orders. You've got local authority searches, land registry searches, environmental searches for flooding, radon, mining, and drainage searches.
And you pay for those even if the sale falls through.
Exactly. Even if the search reveals a huge regulatory defect that kills the deal.
Then there's the mortgage exit fees, the fees charged when you finally pay off and close your mortgage.
The Financial Conduct Authority regulates what's acceptable here. Things like deed release fees, land registry charges, and reasonable staff costs are fine.
But what's not acceptable?
Crucially, what's not acceptable is charging you interest penalties or for the lender's potential lost future income. If lender tries that, they're violating the rules.
Finally, let's tackle the complexity of property taxes. Stamp duty land tax, or SDLT, in England and Northern Ireland.
It's complex, it's progressive, and it has some significant surcharges.
Okay, let's start with first-time buyers. There's an exemption, right?
There is, but the definition is ruthless. A first-time buyer is someone who has never owned an interest in any property anywhere in the world.
Anywhere in the world.
Anywhere. And if you're buying jointly, both of you have to meet that definition. The property also has to be your main residence.
Okay, now the complexity explodes when you talk about the second home or buy-to-let surcharge.
This is a big one. It's an additional punitive SDLT surcharge on purchases of £40,000 or more if you already own an interest in another residential property, anywhere in the world.
And it's not just for investors, is it? You can catch normal homeowners who are just moving.
It does. If you buy your new main residence before you've sold your old one, you have to pay the surcharge up front. The good news is you can claim a refund if you sell the original property within 36 months.
That's manageable. But what about the truly disastrous unintended consequence this creates? The scenario where a parent helps their child buy a property.
This is a classic trap. To secure the mortgage, the lender might insist the parent is added as a joint borrower for security. The parent isn't going to live there, but because they now hold a legal interest in a second property.
Oh, no.
Two things happen instantly.
What are they?
First, the child immediately loses their first-time buyer exemption because they're buying with someone who already owns a property.
And second,
the parent is now deemed to be buying a second home, which triggers that immediate and inescapable second home surcharge on the entire transaction.
so just by trying to help their child, the family ends up paying potentially tens of thousands of pounds extra in tax, plus they lose the first-time buyer relief.
All because they had to be a joint borrower. The rules are ruthless, and knowledge is really your only shield against them.
So to summarize the journey we've taken,
Mhm.
we've gone from structural legality in defining permitted development to invisible environmental hazards like radon.
We've addressed the shocking liabilities in renewable energy contracts and walked through the tricky financial traps of the HLC, the MIG, and that devastating SDLT surcharge.
Okay, if we connect this to the bigger picture, you can see that the entire regulatory framework is designed to protect the integrity of the property as a lending asset.
Exactly.
Understanding all these factors is the key to transforming yourself from a passive house hunter into, well, a critical asset evaluator, thinking just like a lender.
And we'll leave you with this final thought to mull over. You now know what work is covered by permitted development rules for your own potential new home, and you know the consequences if you violate them. But what about the house next door? If a neighbor's extension contravenes the original planning consents for their property, what influence does that violation have on the future value and insurability of yours? Something to consider when you look at that busy street scene.